welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me today is Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you.
Now, on 31st of March, the government announced massive reduction in interest rates of small savings schemes, and naturally the move saddened many investors. But in less than 12 hours, the government withdrew the order, probably fearing its fallout. Now, Dhirendra, can you please explain it to us what exactly happened there?
Interest rates on small savings change every quarter, and it's by a set methodology. The rates get aligned to the corresponding, there are different tenures or there are different terms of the different small savings instruments that we have. And similar government tenure bond, the prevailing interest rates, it gets aligned to that. But what has been, because of the pandemic, last 1 year there has been no such change. Otherwise it used to be a mechanical exercise. Every quarter the rates on small saving schemes will change automatically, very much in line with the changing rates. This quarter, very much in as was the methodology, it was announced by the set methodology, and then the government realized that this may not be an opportune time to be doing it. It might not be, maybe this is democracy at work, because a lot of people are in difficulty, and particularly the people who depend on their investment for income and rely on that. And it would have been very, it would have been very hurtful for those people. So maybe the government wants to postpone it till possible. And so that is perhaps the reason, and that is why it has not been changed in the last 4 quarters.
So do you think this decision might be rolled back yet again, probably in the next quarter, starting July 2021?
Will it be revised next quarter? I don't know. I don't think the situation has changed at all. And a certain segment of this audience, the people who are addressed by, who are being addressed by this particularly senior citizens who are addressed by this small savings schemes, I think there's a strong case that why they need to be treated differently, why they need to be treated in a preferential way. And I think from that standpoint, some of the schemes, even if the government is forced to change or revise the interest rates downward, I think certain schemes might get exempted.
And as you rightly pointed out, many retirees rely for income on such schemes and are getting stressed day by day with the falling interest rates. So what do you think they should be doing?
I think the first stop for most retirees, most senior citizens should still be senior citizen savings scheme, the post office MIP, and Pradhan Mantri Vyay Vandana Yojana offered by LIC. These provide you guaranteed income, and these are the absolute safe avenue for investors. So this should be your first stop. Then comes, supplementing. If you are still left with money, then look for the debt fund. There are still debt funds which will provide you 7 to 8% return without assuming any significant risk. And if you are a little careful, you can also you can eliminate the risk part with little compromise on return. And when choosing a debt fund, don't look for the best performing debt fund. If you follow this rule, I think your fixed income, your income requirement from fixed income can be met very nicely.
But I believe the return from debt funds are not guaranteed, so they're risky and have also been in the news lately, and not for such, not for good reasons.
Yes, I would say that you should look at it as a supplementary income. They are not guaranteed, but if you choose a certain kind of debt fund, they are not very risky either. And many people think that debt fund, because they do not guarantee return, which necessarily mean that they are risky. Not really. There are debt funds which will, the decline in the value, even if they go wrong, even if they commit a mistake, the decline or the depletion in the value of a debt fund is not that significant unless until it meets with an accident of a very unusual kind, as it happened last year with of the kind which investors were faced with the Franklin Templeton funds. But that I think one should look at it as an exception than a rule. Otherwise, most debt funds, even if the fund which has been disappointing, you lose 1 or 2% and the fund recovers in 5-6 months time. The diversification of a debt fund is also a very significant risk reduction. So I would say that, and many funds have been able to demonstrate, if you are little less greedy about your choosing your fixed income or the debt fund, you are unlikely to face any big decline in value.
So are debt funds sufficient alone?
No, debt funds are not sufficient alone. And I think depending on how comfortable an investor is, or what is the scale of his investment, and what part of his income is met by the return from the debt fund, investors need to consider a definite allocation to equity. Because when you invest only in debt fund and consume all the income generated by a debt fund, uh, you will fall short of money, because 5 years from now the income will not be enough, because your capital remains constant and the income might vary, and if you are somehow able to manage with it, your need for income will increase. So to supplement that capital, that can be had only from equity. So depending on what is the scale of your investment, how good it is, because if you are able to derive income from fixed income and a part of it you are not consuming, then it will be growing. Otherwise, you have to make a definite allocation to equity, and that could range between anywhere between 10 to 30, 40%, depending on the scale of your investment. Do it in a calibrated manner. And I think two rules which every investor should follow when he's trying to look at investing in equity, to supplement his, to make sure that he has enough capital, or just to provide the inflation protection for his overall investment portfolio. I think two rules which will reduce his risk, and that is very crucial, because this is the stage when a senior citizen is advised that you can't take risk, you have to avoid risk, you should not be investing in equity, which to my understanding is not a wise thing. One should embrace risk, and embrace risk or invest in equity in a very desirable, in a calibrated manner, which is one should diversify, and one should not invest lump sum. One should spread one's investments over time, and don't try to speculate with your equity investment, because that is what most investors end up doing. And once you do it with this in mind, I think you will have an equity portfolio which will be able to supplement your capital over over a longer period of time, which is, and then all the gains from the equity can be put into fixed income every 5 years, which will go into create produce higher income for you.
Okay, time now to move on to the viewers' questions. The first one comes in from SK Sharma, and he wants to know if floating rate funds are the best choice in the rising bond yield scenario.
Yes, floating rate bonds, floating rate funds, and short-term bond funds, because the short-term bond funds are the other vehicles which are less vulnerable to changing rates. Uh, so yes, these are the two vehicles. And in India, the problem of floating rate funds is that they're investing in, we don't have floating rate instruments. So most of the floating rate instruments are created artificially by adding some derivative around it. So look at the cost. I have found that many a times some of these floaters, if they may not be producing meaningful return for investors. So choose from arbitrage, short-term funds, and floaters. And it's also important for investors not to chase the highest possible return, because they also come with some kind of hidden risk which may not be visible today.
You just mentioned the arbitrage funds. Our next viewer, Swagato Ganguly, wants to know what are arbitrage funds and are they better than short duration funds?
Arbitrage funds are, they have the character of a debt fund, but technically they are equity fund. The way it happens is the fund manager buys a future contract, and also buys a stock, and then sells a future contract, and in a manner that the different anytime there is a difference between the worth of the future contract and the current position in a stock, that difference, that premium, he will be able to pocket on the expiry of that contract. So and these contracts, this kind of discrepancy or this kind of arbitrage opportunity get created, and they produce somewhat like a prevailing interest rate kind of return, or those kind of differences, because arbitrage by its very design is self-cannibalizing. If something is available 1 month from now at a certain price, and the current price is X, and if it is available at X, 5% more than X a month from now, then this particular difference will be used by many people by doing a transaction to consume it, or to to cannibalize it. So in that sense, so arbitrage funds are a different kind of vehicle, and these are very tax efficient. They used to be more tax efficient because what happens is short-term capital gains from equity fund is taxed at 15%, and the long and whereas less than 3-year investment, any gain from your debt fund for a period of less than 3 years will be added to your income, and depending on your tax bracket, which can be 30, 35, in people in the highest tax bracket will find the arbitrage fund, the return from arbitrage fund, very tax efficient. Nothing beyond that. Otherwise I don't see the difference in the return of a short-term bond fund or arbitrage fund is going to be hugely different. And also the difference in the return may not be anticipated. Sometime it could be more, sometime it could be less, depending on the market complexion. So don't bank on the return, but I think tax efficiency of an arbitrage fund for anybody in the highest tax bracket can be quite meaningful.
Right. Chandra Jaiswal thinks this may not be the right time to start an SIP. So in that case, where and how should he invest?
No, Chandra, I would say that, don't make such assumption. Why do you think it may not be a good time to start your SIP? It is always a good time to start your SIP if you are going to, invest for a few years. And if you are going to invest for 5 years and more, any kind of market, whether it is a declining market, if it's a rising market, or if it's a market which is not going anywhere, there could be a long period of, there could be a phase in the market when the market is just adrift. It goes up, goes down, but actually not going up or down meaningfully. So in either of these, if any of these three situations, I think it's a good time to invest, start your SIP if you are going to invest for 5 years and more. And if that investment is, you don't have an income requirement, you don't need that money in the foreseeable future, by all means, start your SIP, stick to that plan, and don't get distracted.
All right, now Arun Bansal asks, which are the most important ratios while checking the performance of mutual funds? If you could please tell him about both equity and debt.
There are many ratios, but I'm not a great believer of in ratios. I think look for three things. I'm telling you things which are not ratios. When looking for a fund, look for a fund which has a full, a performance over a full market cycle. I like a fund which actually falls less than its benchmark in a falling market, rises little more in a rising market, and which means that here is a fund which will not be extraordinary. But if it does little better in a falling market, does little better in a rising market, overall it will do exceptionally well. The other is that make sure that the fund manager who is responsible for producing these returns are, he's still there. And the third thing which I'm always looking at is the general portfolio. That if the portfolio is diversified enough, then I would say that all these things, all the return is not a matter of accident. It has been done by somebody's wise selection of securities in the portfolio and building it in a manner which was opportune. Because there are situations, where when a fund manager goes right with a specific sector or a specific stock, and that could be resulting from a very concentrated portfolio. So if all this has been achieved with a diversified portfolio, the fund manager is still there, and the fund has done well in a falling as well as a rising market. It's a great fund.
Now, the next query has been sent in by Anirban Roy, who wants to know about the options available in debt funds to generate a steady income after retirement. Would you suggest balanced advantage funds along with pure debt funds? He asks.
Balanced advantage funds could be a good, good supplementary deployment avenue for you. But debt funds, but as I said, initial part of our discussion today is for your need for guaranteed income. If you are going to depend on income from your investments, your first stop should be the Senior Citizen Savings Scheme or the Post Office MIP or the Prime Minister Vandana Yojana offered by LIC. There you can together, I think you can deploy close to 40 lakh rupees, and that will produce you a very reliable income. And beyond that, maybe for if you have not invested in equity in your life or year before, and if you are not used to the equity volatility, balanced advantage fund could be a good vehicle to begin, and it could be a conservative investment for you. and this can help you supplement your income over a period of time, because 5 years from now, if you need higher income, that is where it will come from.
Hitendra Mehta wants to know your opinion about existing investors of banking and PSU debt funds, considering the recent perpetual bond issue raised by SEBI. So, should people stay invested or exit?
The perpetual bond fiasco has already happened, and it has happened in case of Yes Bank perpetual bond, which some funds invested. And I think that this is something which one should be conscious of. Not too many funds are affected by it, but the funds which are, I don't think you can do much about it, because everything, the impact on the fund already happened. If you are an existing investor, stick around. I think the fund companies, it came as a surprise, and the hit is over. The damage is done, and you have to bear with it. And I think what something good can come out of it in course of time, but the damage is done, and you really don't have much of a choice today. If you are invested in one of these funds, don't get out of it in a hurry.
Now, C. Kumar asks, how is return from debt funds related to interest rate?
The linkage of interest rates to debt fund is actually on two fronts, and investors should understand, very intimately how it works. When a bond fund is nothing but it's holding a certain, a bunch of bonds, and if when interest rates go down, the the fund will continue to get higher returns, higher interest on the prevailing bonds that it holds. So that is why when interest rates go up, the return from new bonds that will be issued or which a fund will invest will be higher. That is why the bond prices, or the price of those bonds held by the existing bond fund, they go down in value. The opposite happens when interest rates go up, when it goes down, because when interest rates go down, the fund manager is holding a bunch of bonds which will yield, say, 10%, and if it has come down to 9%, the bond prices will, which the fund manager or which your fund owns, they will go up in value, because they will continue to benefit from higher interest rates till the expiry of those bonds which is held by them. So there is an inverse relationship. A bond and those bonds which have longer maturity, they tend to benefit benefit more when interest rates go down. So the bond fund which have longer maturity, they are also hurt more when interest rates go up. And when so this is a one-time event. As and when interest rate change, or the outlook for interest rate changes, there is an impact on the bond fund. There is another thing which happens. If interest rates go up or go down, then the current yield on the existing bonds will also change. So bond funds actually get two things. One is that appreciation or depreciation on the bond that they hold, and the interest repayment, the not interest repayment, but interest payment that accrues on that bonds, whether it be annually, semi-annually, quarterly, whatever be the, depending on the term. So that interest rate which a bond receives, which a bond fund manager or a bond fund owns, that can come down or go up depending on the prevailing interest rates. So these are the two kind of things. So by and large, there's a one-time impact, and then there is a continuing running impact depending on the interest rate.
Rishi Agrahari has sent in today's next question, and he asks, how should a person retiring today with 1 crore rupees allocate and invest his money?
Depends. Depends on how much income he requires, and how much income he requires, and he has access to any other income avenue. If he has access to, or if he'll be getting any pension, or if he has any rental income or any such thing. First and foremost, do an estimation of what will be your income requirement, how much money you need every month for consumption, and how much money you need annually for ad hoc consumption, maybe some event or some such thing. And depending on that, you should plan your investment, because you will have to assume greater risk if your income requirement is very substantial. I would say that if your income requirement is about 6%, then you run the possibility of investing in a manner where your investment will not only generate this 6% return, which is about 50,000 rupees a month, but also protect the worth of your capital, because if you are generating 6%, if you are consuming 6% return, and if your 1 crore investment is generating 9 to 12% return with a diverse portfolio and with a reasonably conservative asset allocation, then half of the return of your investment will be there to is protecting the worth of capital. You will consume half of the return, and half of the return will be retained to support a higher income requirement for you. So it requires careful planning, but I think you can do it yourself by applying these thoughts on where to invest, and then spread your investments, diversify, and your equity investment should not be invested at one go.
Anand Prakash Yadav wants to know, how are corporate bond funds different from short duration funds? Are they a better option?
Corporate bond funds invest in companies' bonds only, and short duration funds could be a mix of corporate bonds as well as government bonds, and government bonds of a wide variety. So on the risk return front, the short duration funds might turn out to be little less risky. It can also have a longer duration, longer maturity, because corporate bonds are not available with long maturity. So corporate bonds might look more rewarding in the short run, because, and if it actually slips on the quality scale, if there are corporate bonds with lower credit rating, they might be yielding higher return, but they will come with the risk, and risk will visit you once in a while. Before that, you can only see return. So just be careful with that. Don't chase the best performing debt fund. That is a cardinal rule which any fixed income investor should follow.
Now, today's last query has been sent in by Tanmay Mohan, who wants to know how to rebalance portfolio in case of SIP investments. Also, won't rebalancing yearly increase the tax implications, as some units can also attract short-term capital gains tax?
Yes, the way to rebalance in a tax efficient manner of your ongoing SIP investment, if you have chosen to have, if you have decided to invest half of your money in equity, half of it in debt, the simplest way of doing it is every year you change your incremental investment in a manner that it gets rebalanced. For example, if you start your investment of 10,000 rupee in a debt fund and get 10,000 rupee in an equity fund, and you want it to remain 50% each at the year end, and then at the end of 1 year you realize that your equity investment has become 40% because it came down in value, and debt has actually gone up by 8-9%. So invest the future money, the future 10,000 rupees a month, in a manner so that it gets rebalanced, and in a manner that your incremental investment will be happening in a manner that you'll be investing in something which has done poorly, and you'll be investing less in something which has done much better. And that is how you will achieve the asset allocation which you have targeted for yourself.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Bye for now.